Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we are in for another sneak attack and it's not going to be fun. What are we talking about? We're going to discuss it in this video. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Bob, it looks like we might have our own Pearl Harbor 2.0 moment in the markets from the same country. Can you explain what's going on here?
Yeah, just like the Second World War, Japan reluctantly attacked the United States to buy themselves time. And I think they're going to have to do it again this time, but they're going to use this weapon called the yen in order to do it. And just to give people historical background here, the Japanese have been the marginal buyer of our debt and of our equities through what they call the Japanese housewife, where they would sell yen and they would buy equities or buy things that are yielding higher than the Japanese yen, and they would basically pocket that. And that's called the carry trade. And that's been going on since 30 years now. But we're starting to wiggle on this. And now we're starting to see articles come out. You know, we're not the only ones that have discovered this, that Japanese hiking cycle. The Japanese, they've already started their hiking. So if the Japanese have to continue their hiking of their interest rates to protect their currency, they have to sell bonds. And the bonds they're selling are U.S. Treasuries, just like China has been doing, just like England has been doing, just like the Middle East has been doing. Everybody is now succumbing to King Dollar. And the casualty of that is that they have to sell the bonds that they're holding in reserve. And I'm going to throw this back to you, Phil, because you know the number that we have to watch out for. But before I do that, let me interrupt. I apologize. Let me just show you how many bonds Japan owns. They pretty much dwarf everybody else. And so if they have to start selling bonds, it's no bueno. China will probably be out of our bond market here. They're at a point now where they're like, they can't sell anymore without causing themselves great harm, but they may not have a choice. We're making it very difficult on them. But if Japan goes, Japan's been very active in our equity markets. So with that, Phil, I'm going to throw it back to you, kind of walk people through the line in the sand, if you will.
Yeah, and it wouldn't be a malicious selling of the treasuries. It would be just out of pure need because, you know, if you have basically a little bit of a buffer there that you can help with infusing much needed cash, and you don't have to, because right now, otherwise what they're doing is they're basically sacrificing the yen, which ties us into this next chart. This is the USDJPY chart here on the right, and here is their yields over here on the left. You'll notice that when we go up into the 150 level on USDJPY, this is kind of a known level where the Bank of Japan will intervene. And by intervening, they will make sure that the yen gets a big moment of strength. And that's why this dropped, because this is the US dollar against the yen. So when we crack that level, it's kind of an emergency line in the sand for them, because that's where they're afraid that the yen might spiral out of control. And then that's going to have, you know, an inflationary spiral for the country and yada, yada, yada. So we're back up there again. It's like they came in here and it's like the market just didn't care and it ate it all right back up. Part of the problem is that they're having to do these unscheduled bond purchases. And under their current regime, that means printing more yen. But they're running out of room here. And I think, Bob, to your point, that a lot of people aren't looking at potentially the catalyst that will come from this situation. So one of two things is going to happen. They're either going to relent and say it's more valuable to them for their currency to not spiral out of control against the dollar. And then they say, we're going to go into a tightening cycle and we're going to let this thing go beyond 1%. Because these lines here on the chart, Bob, are the past two caps that they had, right? They had 0.25 cap and then a 0.5 cap. And all of this is why the yen has been devalued, because they have to burn yen to prop up their bond market, to buy bonds to keep the yield down at the cap, right? This is how weak their bond market is. Now what you have is the US bond market is weak as well, right? That's why we're seeing rising yields. And the saving grace with Japan was that, well, they're yields are down, and that way, it's like we have this nice cheap yen that we can use. Well, that's going to go bye-bye now. And if the bond markets are going on sale across the world, nobody is going to want Japan bonds. They're going to pile into the US treasuries, right? So I think the writing's on the wall for the Bank of Japan. They're not going to be able to overcome that. Now that the bond markets are on sale across the world, you just don't have the quality in the bonds over there to prop them up anymore. So I think what they're going to end up doing, Bob, and this is that article, was I think that they're going to go ahead and finally say, you know what, the decade of easing is over. They're the last central bank really in the world to accommodate, right? And that's the carry trade. So when that blows up, I think these markets are going to get roiled. And I think this is probably our biggest risk. I don't think it's a bond market selling off. I think that is somewhat contained and there's liquidity in our system to deal with that. But Japan announcing they're going hawkish like our Fed has, and they're the last central bank to do that, I think that's going to be the nail in the coffin for the markets. And then that's probably going to send us over into that recession trade, ultimately where the equities get roiled to a point where then everybody's going to go that flight of safety into bonds and get that guaranteed return while we get through this recession.
Absolutely, and you have to look at it from the Japanese standpoint. When they dilute the value of their yen, that causes the people. Remember, the corporations love it because they get an advantage, but the people don't get an advantage. They just pay higher costs to live. And you're at a point now where it's going to become politically unpalatable. And if the Japanese yen flips and their interest rates go up over there, the Japanese are going to buy the Japanese bonds and they're going to get a real rate of return because they're going to get deflation back there again. And so it's going to be really, really interesting because they can't sustain it. And I've said this a million times, anybody who's willing to listen, is that you don't have a nation unless you can feed yourself and you can energize yourself, or your exports have exceeded that. And I think they're at a point now where it makes more sense to lower the cost of food and fuel than it is for their export economy. So, and when this thing goes, Phil, it's not going to just go to 150 to 151. I think there's so many stops at that area that they're just going to blow right through. You imagine how many people have fingers in the dike right now? Mm-hmm. They're just going to get blown off of Lake Mead here in the Hoover Dam, and they're going to be heading down the river. And so when this thing goes, it's going to be explosive. And that's why we're always worried that this is an event. Nobody's talking about it until this very week. Have people talked about it? You and I follow this all the time, especially you because you trade Forex. That you've been watching that number like a hawk for a long time.
Yeah, and here, look at the weekly chart on the yen, right? So the last time they had major intervention at this level was back in October of 2022. Well, what happened then? We were at our market lows. That was near the lows of 2022, which Bob and I have said we're probably going to revisit. So this tells you how much of a disconnect we have here and how much air is under this market, because there is a correlation with the yen and our markets. And here the yen is at, basically it's implying that we're way over fair value on the S&P 500. And I think today we're seeing an S&P 500 move down that a lot of people were thinking we were going to be up into OPEX, potentially up into October, Pumptober, right? And we're not seeing that follow through. The net liquidity is going up, but they're discounting. And I think what's happening is because we keep pounding the table on this, Yellen is issuing out that long duration. And when that happens, and when the T-bills start going from issuance to redemption on net, it immediately affects the markets, no matter what the narrative is, no matter what's going on. That's literally what is controlling the flow in these markets. And so I think we're seeing that. And I think, like we were warning, we're going into basically another first half of 2022 moment. And if you guys look at what happened there from January to June, basically extremely volatile and a bunch of lower highs and lower lows. So that's why we're warning for October, November volatility. And I think we're starting to see this turn down that we've been expecting.
Yeah, absolutely. And we won't beat a dead horse anymore today, guys, but watch 150. Put that in your notebook.
Yep.
And one thing Phil and I talked about beforehand is once these institutionals start selling, you don't have to worry about zero TTE getting in the way. They'll wash it away like it's nothing.
Yep.
And that's why you got to be really careful now. A strong dollar, it'll start blowing everything away. Even my precious energy stocks and precious metals, if the dollar really goes and the yen goes, then there's really nothing to prevent basically a whiff of deflation, they call it. And it's going to scare a lot of people. And I think that's where we're going to get the everything sell market.
All right, Bob, thanks. Thank you guys for watching and tuning in. Let us know your thoughts below on this. Do you think we're going to see another BOJ intervention at 150, or does things get really crazy and we start breaking over that? Let us know what you think. Until tomorrow, guys, thanks for watching. Please hit like and subscribe, and we'll see you on the next episode. Take care.